Stand is 3 minutes late. I can see a few folks have already welcomed Rob back from his overseas tour. If I'm not mistaken, Rob may have gone to some places such as Israel, and he had a wonderful time over there. Got some great investment ideas too, so ask him about those in the chat. Said that they're some of the best investing ideas he's ever come across. So, and he did just share an update actually to say that the live show, thanks in part to the live show, I should say, Selfwealth's YouTube channel, 9,970 subscribers, sorry. So if you are one of the 30 people that haven't subscribed, don't know, just have a bit of self-reflection and just think about that for a moment, and what could be achievable if you hit that button. Okay, so tonight we're going to be going through a few different things. We've got Nick joining us. He's standing by, ready to share some of his company ideas with us, and they're quite unique. And I think if you haven't invested globally, you're about to get your eyes open to what's available outside our shores. And I got to admit, it's very, very, I guess, interesting to me because some of the world's, indeed, probably the world's best businesses are outside our shores. So Nick's going to give us a bit of a, I guess, look into some of those businesses and some of the businesses that maybe you don't know, but you can understand quite easily because there are similar businesses in Australia just at a much smaller level. So good evening, Paul. G'day, Robert, CP. Hello. So I'm going to share my screen because there's the two things that you know and love. The first is my joke, which I don't rate this week's joke very highly. I've got to be honest. But I will deliver it anyway. My cloning experiments finally paid off. I'm so excited. I'm beside myself. Now, there were quite a few others for me to choose from, but this one was definitely the most PG. It turns out I did some digging into this. The person who runs Dad Says Jokes, he actually started it because his dad kept on giving him dad jokes, and he made a channel about it. And then he went on to start a whole another media company and was one of the people who worked at Lad Bible, if some of you guys know that brand. It's a really a video meme-heavy brand that created like an online kind of cult following. So the Selfwealth Live disclaimer goes something like this. Selfwealth Live videos contain general financial advice only. That means the information has not taken into account your needs, goals, or objectives. For example, if you want to retire and go live on a yacht in France. So you should not act on the information until you have spoken to a licensed and trusted financial planner. I am Owen. My name is Owen Rask. I'm the founder and director, the sole director of the Rask Group Proprietary Limited, which is a corporate authorized representative. We call that a CAR in the industry because finance people love acronyms. CAR, number 1280930 of Wattle Partners AFSL 383169. You can take a look at our financial services guide on the Rask website. That's rask.com.au/FSG. Some people do actually look at it, and every time I see that in my Google Analytics, I'm like, you know what? That's great. People are diligent and they are looking at what services we can and can't provide. Finally, the views expressed in the live streams are solely those of myself and all the guests, such as Nick tonight, or anyone else in the chat, and do not necessarily reflect the views or opinions of Selfwealth. Rob had to take a break. Apparently, the reason that he did go to Tel Aviv is because he had to just get away from the disclaimers. He just had too much of a good time with the disclaimers. And so he thought, well, I just need to get away and maybe just rejuvenate the batteries. And here we are now. Okay, so we are talking global value investing tonight. We do have Nick Cummings with us tonight. He's just waiting in the wings, ready to get going. We've so far been through 3 sessions. The first 2 with Gaurav Sodhi. We talked about Value Investing 101 and how to get started picking individual companies for your portfolio. Then we talked about value investing in practice, and we used Lavisa and RPM Global. 2 really impressive companies. Indeed, they're probably 2 companies that are in my top 20 on my watch list here in Australia. So I'm glad Gaurav brought those to the table. And just a reminder that if you are looking at RPM Global, it trades under the ticker symbol RUL, not RPM. Some people get confused. RUL is the one that you want. In part 3, we spoke to John Addis, the founder of Intelligent Investor, who talked about the stories that people tell, companies tell, and we tell ourselves when it comes to investing. We spoke about how writing has a very strong connection with thinking better, which is obviously really important when it comes to long-term investing. We spoke about FANG companies like Amazon, Microsoft, not so much a FANG, Alphabet, and Apple in there as well. For part 4 tonight, we are going back into global markets, and we are going further down the market cap spectrum. So what by that I mean smaller companies, not small by Australian standards, but smaller by global standards. And you will see 3 bottles of Penfolds Grange down the bottom right-hand corner there. I was informed by Intelligent Investor that if people do join Intelligent Investor for a steep discount, they go in the draw to win a bottle of Penfolds Grange, which for anyone that's in the chat, I would love to know if you have bought yourself a bottle of Penfolds Grange. I did have to Google how much one of these bottles might cost, and apparently, if anyone knows, I'll give you a digital crisp high five, but they're not cheap. So you'll find all the details of the Intelligent Investor in the description of this video. Just click the link below and you'll find more information before end of financial year. There is a sale running. Okay, so please welcome to Selfwealth Live, Nick Cummings. Nick, as his bio says, is a style agnostic investor. Nick, welcome to Selfwealth Live, mate.
Hi, Alan. Thanks for having me.
I've got to ask because people may just want to know what you mean by style agnostic. What does that mean?
In finance, we like to complicate things. And so one thing we've done over the last couple of years is put people in baskets. You're a value investor, you're a quality investor, or you're a growth investor. And I think that's just bogus. I like to go across styles and look for companies that may fit one particular category or may fit another. I think the essence of investing is just buying something for less than it's worth. Gaurav rams at home every week at the Intelligent Investor, and that's what we're trying to do. And that's what I mean by style agnostic. A stock on 40 times PE might actually be cheap. A stock on 5 times earnings might actually be expensive. So I sort of like to cut across and call myself a style agnostic investor.
I like that. A lot of people do. In investing, for some reason, it's more so than any other field of life, tend to become so parochial. Like they become like single mind. Like I am looking for dividends, therefore I am an income investor. Therefore I cannot invest in insert growth company. So I'm familiar with your background, but I'd love for you to just give us a bit of a overview of where you came from and how you got involved with Intelligent Investor, and then maybe you can tell us what you do day to day.
Absolutely. So I did a finance degree at university. I was actually lucky enough to do it in the United States, in Utah. I went over there on a soccer scholarship. And when I first got there, I was actually doing accounting. And then I came home one Christmas and my dad's an accountant. He said, you know, that's not applicable here. And I was like, oh, yeah. Okay, well, I better think about this and change my degree. So I changed to finance. And at that point, I started reading classic investing texts, pretty much everything from Warren Buffett and anything else I could get my hands on. Then I actually injured my knee, and at the end of university, I had to come back here and get my ACL repaired. And I got a job at Oracle Investment Management, and that was in 2016. And I had a lot of responsibility there from an early age. It was a small team, and the global fund had just kicked off about 6 months earlier. And so I really got in on the ground floor of this new investment product. When we started there, we only had a couple of $1 million under management, and then by the end of it, it was up over $100 million. So that was, I guess, an eye-opening experience, and I had so much responsibility, which was great, and I wouldn't have got that opportunity elsewhere. And then last year, I was looking for a bit of a change, and Gaurav, he gave me a call and said, "Oh, the Intelligent Investor might suit you." And I started reading a few articles, and I'd followed them for a number of years, and I thought, "Oh, this is a great next step, and this is what I want to do." And so my usual days now are pretty much I wake up in the morning, I cover about 20 stocks and then follow probably another 20 stocks, and most of these are global companies. So I'm going through earnings releases in the morning, if there is any economic news that might hit those companies, I guess, or any data that might affect those companies, as well as things like a competitor might be out, or there might be M&A activity or anything like that. That's one thing I like about the job. It's that part of it is completely unpredictable. No 2 days are the same, and I find that rewarding and challenging. So that, like this morning, for instance, that took 10 to 15 minutes. But during earnings season, that might take a couple of days. You might have three or four companies reporting on the same day.
Yeah, right.
And then
I was going to say, how do you keep tabs on the companies? Like, do you use a website or something like this?
Yeah, so we have a software program, S&P Cap IQ is the main, and that just feeds all the data through and lets you know when there's news. But and then you have to follow, I follow companies on Twitter because a lot of the financial information isn't released. But for example, like Alphabet might have a product day, but that's probably not going to be, come up through Cap IQ.
Yeah, I noticed that too. It's always good to follow them on social media, or if it's like Alphabet, owner of YouTube, like have that, subscribe to that YouTube channel, so you get
exactly.
you get the notifications, right?
Yeah.
That's great. I didn't mean to cut you off before, but I was going to say you kind of defined the idea of like what is value investing before when you said it's like buying something for less than it's worth. Do you think that's a fair definition?
I do. I would also preface that you want to get an adequate return if it's, and a margin of safety. You don't want to buy something for 95 cents on the dollar. How I like to think about it too is in probabilities, because things can always go wrong. And what I've noticed sometimes, if your thesis goes wrong, you might throw out your whole entire process. But that thesis might be affected by something that you really had and the company really had no control over. So I like to think about it as if I rolled this dice 100 times with the same conditions and the same information, am I getting an adequate return? Am I buying something for less than it's worth? And I think that's how I try and think about things, because if you just base your decisions on, yes, I bought this stock and it went up, I am great, or I bought the stock and it went down, I think that you lose the process, or you lose your investment process pretty quickly.
Yeah, I like that. And just to recap, there's a few people commenting on the Mo, but in the chat. But just to recap on the price of a bottle of Grange, at least the ones that I saw from the Intelligent Investor were $3,000 a pop. So definitely not something that's on next to my dinner plate. But for those of you that want one, well, you know where you might be able to get one. So a lot of the time people get pretty scared when it comes to global investing. And I think even like the likes of Morgan House will talk about this in his book, that, we always say that this idea of home country bias, like just sticking your portfolio in Australian stocks or Australian bonds or Australian property, it actually seems reasonable for a lot of people because it's what we know and we're familiar with. Whereas like the literature kind of says that you should be looking outside because there's more opportunities looking outside our shores. How do you think about, I guess, some or any of the differences to looking overseas? Like, is there anything that goes into a process that might be unique compared to if you're just looking at Aussie companies?
Yeah, there is. I mean, there's two big mundane technical things that go into it, which are kind of boring but important. The first is currency. So that introduces a new variable to your returns, and it's something you've got to pay attention to. So a local investor, you will have your stock return, whether it rises and falls, and your income return, so the dividends you receive. But an international investor will also have to think about the currency and whether that rises and falls. So over the long term, I don't think it's much of an issue if you plan to own these businesses for decades, and also stick to Western countries. That's a big one. Yeah, emerging currencies can collapse in an instant. So I wouldn't be too concerned with that one. The second one that you need to be aware of is capital allocation, and this is one of the things I find is one of the main barriers for Australian investors to actually invest offshore. And that's because Australia is unique with our franking credit system. And investors, individual taxes are shielded in Australia compared to, say, the US or Europe. So we love our fully franked dividends. And as soon as someone tells us that we might not be getting those, we just don't bother with them. So US businesses tend to buy back stock instead, because there's more tax effective, which boosts their earnings per share because there's a lower or reduced share count on hand. And that's something you just need to be aware of. But the most exciting reason, I think, for actually investing offshore and spreading your wings and leaving Australia is just the quality of companies. If you look at one company we hold in the Select Value Fund, Visa, it trades at 25 times earnings. It's a member of a global duopoly. It's grown its earnings at 10 to 15%, or its earnings per share at 10 to 15% over the last decade, or per annum over the last decade. And you compare that to Telstra, and it trades at 25 times earnings as well. And its stock price is lower than it was 2 decades ago. I think its earnings peaked in 2015 or 2016. The dividends have been cut several times. And if you just weigh up those returns over the last 15 years, they're chalk and cheese. But if you were just looking at the fully franked dividend component, you would miss that return. And so I think that's the biggest thing I'd like viewers to take away is this. The companies overseas are just higher quality and they trade at much fairer valuations.
Yeah, I agree completely. And that's a perfect example of like what we would associate with the blue chip overseas being Visa and a blue chip in Australia being Telstra. Yeah, a friend of mine did come on a podcast recently and talked about Telstra. And it was a few eyebrow-raising moments when that was brought up, but it worked out well for him. So far, so good anyway. So I think like I know what we wanted to talk about is like the main thrust of tonight's show are two different companies, and I've got a bit of your write-up here because I was able to take a look at them prior to us sitting down to record tonight. So I'll just bring them up on the screen for folks that haven't taken up a free trial or joined Intelligent Investor. But you did a 2-part series on KKR Co. So we'll dig into that one second. But maybe for the first business, Floor Decor is a business that I originally called it Home and Decor, and I was thinking that's not right, and you corrected me. But Floor Decor is a business that I believe is held in your global Select Value Fund.
Yep.
Can you tell us, just start at the very top and tell us about this business? Because I was like looking at it on the website, I'd never heard of it, even though it's a pretty big business. Tell us what it does, and then we'll just kind of rip it apart. And if anyone has any questions around this business, please just fire them away in the chat. And I did see a few questions from Harry already, so I'll have time after we say goodnight to Luke to answer many of those questions. But for any of these companies, send them through. Sorry, Nick, not Luke. I was thinking of Oracle, mate. So tell us, Nick, a little bit about Floor Decor.
Yeah, so Floor Decor is a US-based and US-listed flooring retailer. Their specialty is hard flooring products, so they don't sell any carpet whatsoever. So think tiles, floorboards, vinyls, laminate, that sort of thing. They also sell installation equipment as well alongside this. And the store model here is completely unique. So these stores are around roughly the same size as a Bunnings, and all they're selling is flooring. Wow. And this allows them to skip the middleman and pretty much take the inventory from the supplier and drop it directly into the warehouse-like stores. And obviously, once you take out all the middlemen, you have less costs, and then they can pass those costs on to customers. The other big thing the larger stores allow them to do is offer a greater range than other companies can. So they have about 2,300 SKUs or stock keeping items, and that's typically 5 to 6 times what you might see in a competitor like home improvement chain, Home Depot. So that's sort of the overview of what, and there's the store size right there. It's much bigger than the other companies. Our investment thesis really centers around 2 big things here. And one is the store rollout. They've currently got around 200 stores, and we think that can go to 500 stores by 2030. The other one is as it grows and matures, we think it'll get more profitable on the store level. So a store that's been open for 5 years is twice as profitable as a newly opened store. And I might just go back to how it started too. So
yeah, I think that's valuable. That's a good story.
Yeah, the origins of the business. This started in 2000 by Vincent West, and he was infuriated that he couldn't find the right range of tiling for his bathroom. He had to go to 5 or 6 stores. So he created this massive store that was Floor Decor. Then they opened a few stores, and it was taken, private equity bought it out in 2007. And then in 2012, they installed Tom Taylor as chief executive. And his background is pretty important to the first part of our investment thesis, which is growing the actual store network. He started off at Home Depot in the 6th store when he was 16 years old, so right at the ground floor. By the time he's 22, he's the youngest store manager in history. And then by the time he left in 2005, he was actually vice president of merchandising for the entire Home Depot operation. So he saw the store count rise at Home Depot from 6 stores to 1,500 stores over about 25 years. And so he knows all the tricks to manage a store rollout. He knows where the kinks in the chains are. And we're backing him. He's almost the thesis broker. If he were to leave, we'd really question our investment thesis because we think he can drive store growth. And he has so far. So when he first got there in 2012, there was 20 stores, and now there's 200. And obviously the goal is to move that to 500 over the next 7 or 8 years.
Wow. So I'm just wrapping my head around this. So I noticed, because I've read the KKR report as well, how often would you say, when you look at these global companies, how often would you say that the key personnel, so like the CEOs or the boards, like are a major part of the thesis? Because some people would think like these are big global companies, like surely one person doesn't matter that much, kind of thing, if you get my drift.
Yeah. Well, I think Floor Decor, it's key. It is absolutely key, and it's not only Tom Taylor, but it's the rest of the management personnel. So he brought over around 40% of the executives in Floor Decor are ex-Home Depot. So just having that experience on the board and in the management or in the boardroom and at the executive level is invaluable. I would say there are some global businesses. Visa's a good example. I think if you change the CEO of Visa, it's not too big of an issue. It's never ideal, but it wouldn't be too big of an issue. But there are some businesses, particularly ones that are growing quickly, like Floor Decor, and where things can go wrong, that you really need a great management team in place.
Yeah, that's a fair point. So CP said, is it like the Costco of flooring? You can kind of go there, get everything except carpet.
Exactly. It's exactly that model.
Yeah. I saw a note in your research report that said something to the effect of, I think it was, correct me if I'm wrong, 65% of new sales come from competing chains so for new stores. Is that correct?
Yeah, that's correct. And the reason there is they typically win about a third from home improvement chains and a third from independent stores. Wow. So home improvement chains like Home Depot and Lowe's, they can compete on price, but they can only stock 400 flooring items. So if you think about when you go to Bunnings, they have plumbing, power tools, gardening, all of that, and flooring. Whereas Floor Decor only have flooring. So they typically quickly win the professional customer that needs large in-stock quantities and has been disappointed with the service from Home Depot and Lowe's. And Home Depot and Lowe's can't really do much to change this. Their whole business model is we're a generalist and we provide everything. And so they can't really adapt, and there's no really need to. The stock returns have been great. Investors are happy. And then on the other side, the independent flooring chains, they're a much more fragmented market, and they can't skip the middleman. So they have to go to distributors and buy their inventory from there, and that introduces a lot of cost to their operations. So they can't compete on price. So they win customers there on price, and they win other customers based on this product range.
There's a good question that's just come through from CP again, which I'll bring up one more time. So what would you say? So that would be their moat. Effectively, the smaller players can't compete because they have to use a distributor. And the bigger players like Home Depot, which is probably like the gorilla in the room, they can't compete because they'd have to basically like add another 50% of their store print or footprint to then just have flooring.
Absolutely. And flooring's only 6 or 7% of their sales. So there's no real impetus to go and do this, but that is essentially the moat. I don't want to say it's impenetrable by no means, but it's hard to start this now because every new store they add more scale, they add more negotiating power with the suppliers. If you and I were going out tomorrow and opening our own floor and decor, we could do it. We could find the real estate somewhere in a market they probably hadn't touched. But to roll that out nationwide, which they're in, I think, 36 states at the moment, and probably well over 100 cities, it's just very hard to do. It's really, really challenging.
I asked you off air before, like we don't have. I was trying to think. I don't think we had any of these in Australia, and you made a comment about the business, but it relates to kind of like Martin's comment here. If they're trying to roll out so many stores, how does that go? Do they own the properties, or do they lease, or how does that work? Because we know Bunnings in Australia doesn't always own the properties, for example.
Yeah, they have a combined model. Mostly it's leased. And they are finding real estate is key to home improvement, and it's key to flooring, particularly for the professional customer. The professional customer works in cities, so they don't want to have to drive 30 minutes out of the city to go and get their products. So real estate is key, and where sorry, that might seem like a disadvantage for floor and decor because they're trying to roll out all these stores, and where are they going to get the real estate from? But what we're finding is big department stores that occupy big real estate like Sears, which is like almost like the Walmart that went bankrupt, and lots of other commercial real estate buildings, and they're coming up for sale in good areas. And that's a real big advantage, I think, for Floor and Decor, and really supports them growing to 500 stores.
Yeah, because it's so some people here like they don't own their property. That's a disadvantage. Some people say they do own their property because that is a disadvantage. Because then you need money to buy the properties, which may not be available. So you may overpay, and you may not get the location you want. So there's pros and cons to both models, I guess. And so Aaron's touched on a question here, which is something that I was going to ask you. If Home Depot isn't like an exact replica for this business, is there anything else out there that's very similar to it, like kind of trying to do the same thing?
There's a few. There's no one really trying to do exactly what they're doing. There's a few that were already existing chains. So there's Lumber Liquidators. There's a few other, probably I would say 50, 100 store flooring chains. But they've been around for years, and they've never really nailed the model. They never had big enough store footprint, and they never were able to keep the same range of products, and they were never able to go to the suppliers directly and lower cost. Floor and Decor, and again, this comes back to management, were able to do these things because Tom Taylor knew how to do it. He had done it. The business also had a capital structure that allowed them to do it. They're equity funded, there's little debt. Whereas a lot of their other competitors, particularly after the global financial crisis, were hamstrung, and that allowed Floor and Decor to get a leg up.
Yeah. I saw a few comments in here about my comment about Bunnings and BWP. So BWP Trust owns a lot of the properties,
Yeah.
but that suits Wesfarmers, whereas Bunnings, so Wesfarmers the owner of Bunnings, that suits them because then they don't have to have the liability. So just for people that don't understand how this works necessarily, is what typically happens is a business starts up and then it sells off its property separately. Why? Because then it can send the debt along with it. And they can clean up their own balance sheet. So just what you have left is the business, which is why there's probably so many questions about Harvey Norman and the value of the assets on the balance sheet. To be honest, if they just sold the properties and kept the business, they'd probably get a lot less stress. Okay, so there was a question here. I think it was from Tarwin. It was just more around kind of like the macro headwinds that may be faced with higher interest rates. How does that fare alongside kind of the store rollout in your mind?
Yeah, so I try and separate them to a degree. The macro headwind is just that it's a big headwind at the moment. So Floor and Decor do rely on existing home sales, and interest rates have risen from 2% to 5% or 2% to 6% on a mortgage level. That has affected same store sales growth. In terms of the actual store rollout, I don't think it affects that because there's so much space to go and expand to. So, for example, California, which has double the population of Florida, has the same amount of stores. Minneapolis, for example, is a market the size of Melbourne. It only has one store. It can easily fit 4 or 5, even in a recessionary scenario. New York City has triple the population that Miami does, but half the stores. So there's plenty of opportunities to go and expand the stores. But the market is focused particularly on all these housing stocks at the moment, on interest rates and how that's going to affect sales. And it is going to affect sales, there's no doubt. And that's why the stock's fallen 30-odd% from its highs recently, or over the last year or two. But we think that presents the opportunity for long-term holders.
Yeah, right. And so I guess that was probably the thing I was going to say is like when you see this type of weakness in the share price, not necessarily saying we're seeing it here, but when you see that in a business and you know the fundamentals of the business are strong, that indeed is an opportunity. I remember, some examples of technology companies during the GFC that were just sold down. It really had nothing to do with other than just being caught up in the GFC, but the fundamentals of those businesses were stronger than ever, and they were still growing. So I guess the key question for me and probably for a lot of viewers is, this is the Value Investor series, Nick. How do you think about the valuation of this business and like what went into it? And I think this will be interesting because this will also help us maybe speak about the next business in just a moment, which is a fair bit more complicated. But how do you think about the valuation of this? And you've already mentioned one of the risks to your thesis, and what could kind of pull that down is like the CEO leaving. How do you think about the valuation right now?
Yeah, so in our valuation scenario, we've put a bear, bull, and base case. Our base case is they get to 500 stores. If they don't, and our bear case plays out, and they get to 400 stores by 2030, we still think we can get probably an 8 to 9% return, assuming a market multiple as an exit rate. That's debatable, and people say, oh, you can't assume that, and you should do DCF, but that has its own implications anyway. So even in our bear case, we think there's a margin of safety, and so we look at it and we think this business can probably do 18% EBITDA margins as those stores mature, because the mature stores are much more profitable. And we think the free cash flow will be excellent. So the free cash flow at the moment is completely masked because they're rolling out so many stores, and they're mainly internally funding this. It's similar to Lovisa in Australia, and that's a stock that Gaurav hangs on about quite regularly for good reasons. And we think the same thing will happen here. And if you look at, again, if we go back and we'll look at Home Depot, because I think it's going to be a very similar story. They expanded from around 800 stores in the late 90s to about 2,000 stores by 2010. And the cash flow was pretty much masked the whole time. If you actually looked at the cash flow statement, you go, this business is capital intensive. But what was happening was they were rolling out store after store after store. And then once they stopped, the cash flow came in, and then they were able to halve the share count over the next 10 years and produce fabulous returns on top of the great returns they'd already produced. And we think Floor Decor will probably end up the same way. Is once we get to 2030, we don't think the story's over. We think that's when we'll start getting all the cash sort of coming into us. And so if you assume a market multiple and 500 stores in 8 or so years, we think you can earn around a mid-teens return from here.
That's I love how that's kind of so eloquently put. Like your thesis is like the store rollout, right? And you're not, by saying like we expect the shares to be in line with the market. It's not like you're assuming. Some people, when they do valuations, they think, well, I'll just buy it here and then the valuation is going to go to there, without really like connecting those dots. But you've kind of done that for us nicely there. So just to recap then, or just as a summary, I'd like to just maybe leave people, because this sounds like it's definitely one that's going on my watch list, for example. But just to recap some of the risks that you mentioned. So we've got potentially the CEO leaving. Not that seems like it's going to happen or you have a crystal ball. It's just, it could happen. It's important to be aware of those macro conditions, but to try and, I guess, dislocate them from the actual fundamentals of the business. What else was there anything else that you would maybe throw at us? Like there was a good question in here about suppliers and things like that. Is there anything else that stands out in your mind?
Not really. A supplier concentration is a little bit of an issue, but it's more an issue on the country level. So they do get a lot of supply from China. I think it's around 40-odd%. So if something were to happen there, could be disrupted. The only thing I would say is that's in a situation that's going to affect everyone. it's going to affect all the competitors as well. And they have the best sourcing and the best supply chain in the industry, so they'll arguably probably be able to possibly take share in that scenario. But that is another risk. The other thing too about the macro environment, it's important to point out, is we are talking about short-term stuff. So interest rates have risen, housing construction is down, but the long-term picture for this industry is actually quite bright. Since the GFC, America has massively underbuilt housing. It's estimated they need to build around 2 million houses a year for the next decade or so to catch up. And that's to catch up to the current population without forecasting any population growth. So that's going to be a big tailwind eventually. Just at the moment, that's the macro is a bit of a headwind, but I think the actual forces behind it will eventually shine through.
Yeah, that's been something that's been playing out for quite a while, quite a few years. 2 million a year, did you say? So
per year for a decade, and I mean that comes from the GFC, where building went from 2 million down to 300,000 for 5 or 6 years, and had only really recovered until last year. It got up to around 1.7 million, which is about the run rate you needed, but that's now fallen to 1.3 million. Yeah. So they're already in deficit again. I mean, it's a similar thing to Australia, right?
I was going to say, yeah. Except I'd expect the Americans maybe to get closer to their goal than us, to our 10 million, or whatever it was, 1 million houses or something crazy. So okay, so that's Floor and Decor, which is a really interesting business that I hadn't come across once before. Can you maybe switch gears now and introduce us to this next business? And we just kind of want to set the scene here. This is a business which we'll try and walk you through, because you may have heard of it, but you may not necessarily truly understand what it does immediately. It's not as kind of, I guess, tangible, and you can't just be like, it's like Bunnings, but maybe there are some similarities with other businesses. But Nick, maybe you can introduce us to this business, KKR Co, what it does, and then we can just drop down from there.
Sounds good. So KKR is a global alternative investment manager. Their roots are in private equity, and that's what it's known as. They have around $500 billion of assets under management today. And our investment thesis here centers around 3 key points. One is we think they have a strong path of growth ahead of them. For example, their competitor Blackstone has around double the assets under management they do. So just catching up to them would double the assets under management. Alternative assets are also in vogue with allocators, like superannuation funds like Australian Super are allocating more to these companies and to these managers. Our second point is a repaired reputation. This company has had a very checkered past, and it still haunts them, but we think they've made a number of steps, which I'll go into in a second, to fix that up. And the third is this business doesn't really fit well in the market. It's not an investment management business. It's got bits of Macquarie Group in it, bits of Goodman Group. And so the market sort of disregards it. It doesn't show up well on screens because they have to consolidate their accounts of the companies they invest in. So it looks like they have $50 billion worth of debt, for example, on the balance sheet. And the market cap's only $50 billion. But that's not the case. They're actually got about $18 per share, or a third of the market cap in net cash and investments. So there's a lot of reasons why the market misses this. And just comparing it to an investment manager like Magellan, we think this is a much higher quality business, but trades at a similar valuation. So the story starts in 1976. Jerome Kohlberg, George Roberts, and Henry Kravitz were working at Bear Stearns doing leverage buyouts. And they left and started KKR. And the returns in the early years were sensational. We're talking like 35, 40% net returns after fees. And so the assets flooded through the door. And this left them with a problem, because now they had to go and transform bigger and bigger businesses. And so Jerome Kohlberg said to the partners, he said, I think this is very risky. And Henry Kravitz and George Roberts, who are cousins, pretty much bullied him out of the firm. or forced him out of the firm. And his warning was right. In 1989, they did the world's largest leverage buyout, $25 billion, a company called RJR Nabisco, and it was an absolute disaster. So there was a famous book written on it, Barbarians at the Gate, the fall of RJR Nabisco. And this tarnished the reputation. Didn't destroy the firm, but it tarnished their reputation with investors and with the outside public. And pretty much for the next 2 decades, they had to rebuild this reputation. And so they went about this by structurally aligning, or financially aligning, I should say, their interests with investors. So now KKR take large on-balance sheet stakes alongside investors. So, for example, they have a $400 million US dollar stake in Arnott's, the Australian biscuit company, and that's held with other investors. So if investors lose money, like they did with RJA Nabisco, they also lose money. They've also, the employees own about $5 billion worth of the funds alongside investors as well. So we think the alignment has completely changed. Culturally, they've also introduced a few industry firsts. So the biggest one here is employee stock ownership. And this isn't at the KKR level. This is at the investee company level. So this is the blue-collar workers of the companies they take over. And they're actually giving them stock. So if the business does well and KKR connects to this investment with a good return, they'll benefit. And some of these workers are getting 6 times, 7 times, 8 times their annual income when KKR leaves. And then they're also providing financial advice afterwards and accounting for these workers, because they've never, had $1 million or $2 million hit their bank account. So they're really taking care of the employee at the investment level far more than they used to. It used to be they just got in there, fired everyone, levered it up, and did this stuff. And that's no longer the case. I don't want to say that never happens, and there's going to be, they just have so many investments. There's definitely going to be a bankruptcy, and there might be a bankruptcy tomorrow from one of the KKR companies. But the reputation does seem to have changed a lot.
So I didn't know this about KKR until I read your report, because I just heard of KKR through many different ways. And I always just think, I mean, you would remember this when Dick Smith was taken over, and then the retail company, and then it was put on the ASX, and it basically just blew up within I don't even know how long. It didn't take long, because typically what happens for anyone that's new to this, a private equity company in the past would buy another business, strip all the good bits out, and then prop it up with debt or just juice it somehow, and then sell it to someone else, and then it kind of falls apart. Not always, but that's the worst case. So whereas this one is very different, because I hadn't seen this model where so KKR buys a business, so Arnott's, and then the employees of Arnott's benefit from that, and then they get the financial advice. That's quite. I haven't come across that. Is that common?
No, it's not common at all. They were the pioneer of the model, but I think there's now 30 or 40,000 employees within the KKR umbrella that have stock options, and they just want to continue to grow that. Yeah. What I probably should also mention is this company has private equity roots of large leverage buyouts. That isn't the case so much anymore. So only around 45% of the assets are actually private equity. The rest are in things like infrastructure, credit, real estate, and even venture capital. So KKR owns toll roads. They own multi-story apartment buildings in Tokyo. And they also own a piece of Epic Games, the manufacturer of Fortnite. So it's a very different firm than 1989.
Can you, just as a change of pace, mate, can you please explain this?
Yeah, I can. So this is the remaining barbarians. This is Scruffy Roberts. This is the co-founder George Roberts' dog, who flies private all over the world and seems to love beaches and golf courses. and couches. But yeah, it's crazy. And I want to stress there is still, even for the cultural changes, these mostly men in the company get paid extremely well. So the four top people, the two chairmen, the co-chairman, George Roberts and Henry Kravitz, they both have $4 billion stakes. The co-CEOs, Joseph Bay and Scott Nuttall, have got paid $650 million each of the last 3 years. And they also own 2.5% of their outstanding stock each. So there's still egregious fees in this industry, and I want to be clear that I'm not saying that's left. It's still there, and I guess that's highlighted by Scruffy Roberts' private plane.
Yeah, so Paul's just confirmed the dog flies on private jets alone. Yeah. Yeah, so that's it, Paul. It's got its own Instagram. You can follow the dog on Instagram. I don't know what the handle is, but if you are on there, dog's better life than mine, says Angel. Yeah. So
all of us.
Yeah, yeah, that's it. So okay. So there was one line that you had in your research report, which I thought was fantastic. It went something like, "If you can't beat them, join them," kind of thing. Like, you know that they're good at what they do. You know that they're paid outlandish amounts of money to do what they do. But at the end of the day, it looks like a great business because everyone in the business will benefit if the business does well. So it's like the old Charlie Munger saying, right? You want to, go where the incentives are, and you want to see, and you can kind of trace human behavior from there. And if they're talented people, it's like Macquarie, they call the millionaire factory, right? Incredible. So can you maybe just, in closing then, can you maybe just talk a little bit about the valuation? Like, how do you arrive at a valuation of a business like this, which is seems so complicated? Like, it's got ownership of some companies, more ownership of other companies. It has credit, does infrastructure stuff. Like, it seems to be a bit of everything. So how do you bring that all together?
Yeah, it's an extremely complex business. There's an insurance operation, an investment banking arm, and an investment management arm. The annual report is 754 pages. So
Wow.
It's incredibly complicated. So coming to evaluation, there's two main earning streams for KKR. There's fee-related earnings, which you can think of as more recurring in nature. And then there's performance or carry interest fees. And carried interest fees varies a lot. So actually in our valuation, we've excluded them. We just considered them a bonus. The fee-related earnings, on fee-related earnings, I should say, the company trades around 15 times, but we think that drops to around 10 times earnings in the next 2 or 3 years. And the reason why is they have around $100 billion of assets under management that is considered committed capital, but it's not fee earning. And what this means is managers have committed the capital to KKR. They can use it whenever they want, but until they deploy it, they won't earn any fees. So when they deploy it, their earnings will go up. So we think just that alone over the next 2 or 3 years can boost its earnings per share by 25 to 30%. And if you take off the $18 per share of net cash and investments that they have, the share price falls to around $38. And we think by 2026, they can be earning $4 worth of fee-related earnings. And this excludes any of the carried interest. That's just bonus. And that would put them on 8 times earnings, which we think is half the S&P's average multiple at the moment. And this is far too cheap. So we've taken a more basic, probably approach or simple approach to this complex business in our valuation, but this appears to be misunderstood in the market and cheap.
Yeah, right. So I often find that's comforting for a lot of people is that people get overwhelmed. They think because it's a more complicated business, they need to have more complicated tools. Just in the interest of time, maybe Nick, we'll go with one final question is here from Macro Notes. He said, read that today M&A deals, so mergers and acquisitions are down. Down 40%. Would this impact the fees that they collect?
Yes, it does. But that's a very small part of what they do. So that's their investment banking income. The main fees they earn are actually managing the business. So think of it like a fund manager that earns 1% of assets under management. They actually earn 1% of invested capital under management, which is slightly different and actually protects their fee earnings. So assets under management includes leverage used to go and buy these assets. So if assets under management were to fall, say 10%, it still wouldn't touch the actual invested capital level that they're charging on. So we think that, and for this reason, the fees are much more defensive than an investment management firm. But yes, the investment banking fees will be down this year, but the management fees compensate that.
Yeah, right. And I think just to recap on something that you said before, just so people don't understand, the committed capital is when, say, for example, Australian Super says, we've got $10 billion that we want you to invest for us. They give it to KKR. They say, this is the $10 billion we're going to give to you. It's committed to you. But KKR say, well, we don't know what to do with it right now. We'll invest it for you soon, but they don't charge the fees until they get that $10 billion and actually invest it, correct?
That's exactly it. And this is a real advantage, and why another reason we like the stock is because they have like 20% of or $100 billion of assets they can deploy. If valuations get low, they can really take advantage of that and buy some assets really cheaply. And they've done this before. Their returns out of the GFC, the funds they launched then, have been amazing. And the same during the pandemic. They were able to call on capital quickly, invest really quickly. So it's a huge advantage for these firms.
Yeah, right. Well, I know we've got some questions come through from Aaron and Macro and CP. If you guys do want to, please just take up the offer to get a free trial to Intelligent Investor, because there's comment sections and all that sort of stuff there. I did say to Nick that this would be maybe a 30 to 40 minute chat, and here we are 55 minutes later. So I could keep talking all night, mate, but I do respect your time, and I really appreciate you coming on and sharing some of your wisdom. What's really great about Intelligent Investors, you guys do have the funds which people can invest in, but you also provide the research on all the positions, and you respond to comments and answer questions. So whether you're a DIY or a do-it-for-me type investor, there's a lot to offer. So I really do appreciate you coming on this long live show, dealing with some questions from me and from the community here at Selfwealth Live. Really appreciate it, mate.
Thanks, Helen. Thanks for having me.
Cheers. So that was Nick Cummings putting a bow on this 4-part series, and I actually was delighted about that because I think it may have even been Nick's first long-form live interview like this, and boy, did he do well. Brought 2 companies that I don't really know anything about other than what I hear in the news. So thank you, Nick, indeed, for bringing those to us. Aaron CP, I know you do have a few questions, so please follow him up on the Intelligent Investor website. There is a link there. So just to recap on the series so far, we've covered a lot of ground, and I'll bring up my screen. So far we have that's the wrong way. I went this way. We've covered Value Investing 101 with Gaurav. If you haven't started this, down this road of learning about value investing, learning about individual companies, the team at Intelligent Investor, I honestly couldn't point you to probably a better group of people to help you on that journey. So we've been absolutely grateful to have them on the show, and you can go back and you can watch all of these episodes if you haven't already. In number 2, we spoke about RPM Global and Lovisa, 2 really impressive businesses. John was fantastic last week, and Nick tonight, of course. So I will we'll turn over to some questions from you guys. If you want to ask me some questions for the last 10 or so minutes, it'd be great to just to hear them. But coming up soon on Selfwealth Live, you did request that we invite Queenie Tan on the show. Queenie has confirmed her attendance. She will be coming up soon on Selfwealth Live. So stay tuned for Queenie in the coming weeks. We're excited to have her on the show. Many of you may know her because I don't know what that is as a percentage of Australia's population, but let's say Queenie's probably the most followed content creator in Australia for personal finance and investing. And then finally, we will be having BetaShares on the show for a mini series just like this one. We did hint at this a few weeks ago, but BetaShares will be coming on to do a full mini series with us here at Selfwealth Live on ETF investing, and we will be getting to the bottom of things like, are ETFs in a bubble? I really want to know the answer to that question and hear it from the people that create the ETFs and what they see. We will be talking with economists and all different other types of people as part of this series. So that's coming up in August. If you do want to send us your guest suggestions or speaker suggestions, we do listen, because a lot of the people that we've had on the show in the past have come from you. So if you want to chuck them in the chat now, is there anyone that you want us to get on the show? I know you're going to say Warren Buffett or Charlie Munger, and I'll say, if you have a personal connection, please just reach out to him and let him know that we're knocking. But please, if you do want anyone like a fund manager or anyone, as Rob just said, Warren is coming. Don't worry about that. If there is anyone, please pop them in the chat now, like analysts, authors, these types of people. I've got a few on my list who I would love to get on the show. I just need you guys to give me some of those names. Benny, I can see Andrew Dermuth. Well, Andrew Dermuth, Benny, is potentially getting a job at the RBA. It is official. You've heard it here first. He has been called up. I think it was even the Prime Minister that wanted to have a word with him about his ethics. So I will let you know about that, Benny. CP, you've said any resources or course recommendations for learning accounting required for ASX equity investors? Yeah, I mean, sure, you can. Well, yes, CP, there are. I don't know of any specific courses for the accounting side of it, but there are, we offer courses at Rask, and you can use the coupon code Selfwealth to get into those for free. So there's courses on the Rask website. If you Google Rask investing courses, there might be some there. But the best thing you can do, I think, is actually just look at companies and actually read their financial statements. So what I mean by that is go into a financial statement and find out what it is that you don't understand, and just search for it online. So a good example of books on this topic, there's a book called Value Investing. I'll show you the book. I've recommended it a few times. So this Value Investing book, it sounds like, it says it on the tin, right? Value Investing, that's the newer version of it, I believe. But I am thinking of, it's Greenwald and Sonkin. So I'll search for Sonkin, less common. This book right here is a really good book because it takes you through investing concepts, and the I guess the strategies followed by certain investors. And it's a really good book. There is obviously the Warren Buffett letters are completely free, CP. So I would probably point you here. You could probably read them back to front, like as in 2022 and backwards, because you'll probably get more, I guess, substance from those in the earlier letters. But he talks about accounting principles. There's also a fantastic accounting, I think it's, I'm not trying to remember her name, Eli Gresh, I think is her name. I think this is her here. So she is like one person that I learned from many years ago, and she talks about accounting principles. So if you see any of her videos on YouTube which relate to the thing that you're looking at, go and have a look at them. And what else? I think it's a lot there's a lot to know about accounting, but I guess the basics can be ascertained or understood really quickly. So I'll give you some pointers. So obviously when you read the income statement, that's sometimes called the profit and loss, you read it from top to bottom. At the top, why don't we give up a quick example, and I'll give you a crash course. Can I explain accounting in 5 minutes? Let's have a look. So let's go to, say, if you guys give me a company, I will just run with that. Okay. So yeah, reading Warren Buffett and Nick's sleep letters, they're like nirvana. Yeah. Borrow books from the library and read. Says PB, that's probably one of the best things to do. Could you do a dividend mini series for new investors 45 plus? That's great, Robert. I think that's a really good idea. And Paul's on that as well. I think that's a great one. What about Rob's beard? Will it make an appearance? Caroline, I was actually talking about that today. Caroline, Rob may make an appearance, an admin reveal. Chef Circle, someone from Macquarie, you said. Yeah, we can look at that. Okay, Kerr Nielsen would be lovely. Andrew Clifford, we could probably try for Andrew Clifford, to be honest. Not getting ahead of ourselves. Okay, so let's quickly, you've given me Kelly Partners as the idea, CP. So what we're going to do is we're going to find the annual report really quickly. So annual report, this one is the old one, but I'm using the annual report for a reason, which I'll come to in just a minute. If I'm in a financial statement, the first thing I do is press Command F on my Mac. I think it's Control F for a Windows user. And I type in comprehensive because it takes you straight down to where there's the comprehensive income statement. Okay. So in accounting, there are 4 types of statements. There is the income statement, otherwise known as the profit and loss, otherwise known as the consolidated statement of profit and loss. There is we'll keep going down, sorry. That's a continuation of that. There is the statement of financial position, but you would know that as a balance sheet. So there's the balance sheet. There's the equity. Where is this? They split it all over 2 pages. The changes of equity. You basically never have to look at this statement. So basically there's only 3. And then there's the cash flow statement. So let me give you a real quick crash course on how this works. So I'll try and bring this up like this. We start at the top. We read from the bottom down. Revenue is just the thing that you earn when you sell something. If it's a service, we'll call it a revenue. If it's an object, we'll call it sales. So say like JB Hi-Fi might have sales. But at the end of the day, revenue is a more accurate measure of what a business actually earns. You earn revenue when your product or service is earned. So when you actually pass it to the customer, or you deliver it, or you actually give them the service. So expenses are the things that can be broken down and separately identified. In this business, Kelly Partners is an accounting business, right? So it has to pay employees, it's got rent, it's got all of this sort of stuff. You can total them all up and they're here. Now, some of these expenses aren't always cash. What I mean by that is sometimes businesses earn and have to pay for things or have to account for them on their statements when they haven't actually paid the cash yet. So depreciation is a good example of that. If you buy a car, the car is $50,000 and it's got a useful life of 5 years. That means that every year, $10,000 of value is destroyed, basically. And that is what we call depreciation. So that's not cash, but it has to appear here. That's important because I'll explain why in just a minute. So after all, you paid all of your expenses and all of your costs, you end up with profit from your operations. You have to pay income tax, obviously, and then you're left with the profit for shareholders, and that's here. Now, by the way, when we talk about earnings per share or the profits per individual share, we just take this and divide it by the number of shares that the company has. Now, I'm going to jump straight down because this is where people get confused in Australia CP. So when we look at the income statement, notice how I said it's different from cash. Well, we can actually connect it. So at the bottom of the profit and loss, we see the profit result here. So this is the profit. If it was a loss, it would be in brackets. So there's the profit, right? So how does this go from a profit here and then connect to the cash flow statement way down here? How does that look like that? And then this look like this? It doesn't make any sense. Well, in Australia, we do an extra thing to confuse you. So in Australia, what we do is we actually have an imaginary statement that sits between the profit and loss and the cash flow statement. And this is called a reconciliation, if I can spell that, of profit to cash flow. So let me just bring this up here. Reconciliation of profit to cash flow. Let's see if we've got it, if I can find it. Here we go. Okay. So this is the thing that's missing in Australia, but you'll see it in the United States. So in the United States, the cash flow statement starts at the top, which is profit, and then works down. In Australia, there's this missing gap between our profit and the cash flow statement, and that is all found here. So here we can see that we've got the profit that you saw on the profit and loss, and then they adjust it for things that aren't cash related. So remember that depreciation stuff? That all goes in here. But then we also have things that the company might buy or sell, and we call this working capital. And so these are things like if there's tax to be paid but hasn't been paid yet, or if there are suppliers that need to be paid but haven't been paid yet, or maybe they've received something from someone but they haven't paid for it yet, all of that sort of stuff, that goes in here. That's what we call working capital. So now we end up with net cash from operating activities. Let's go back up to our cash flow statement. Okay. I think it's going to be longer than 5 minutes, but it might be pretty quick. Now you can see the same number. So now we've just connected our income statement or our profit and loss to the cash flow statement. And now we can see all of the cash items. So the actual things that they paid with cold hard cash, or they've made a direct deposit. And we can see all of these things down the page. The most important figure that many people say in finance is you take this figure and you subtract basically this figure. And that's what we call free cash flow. That's what Nick was talking about. There are a few other things in there that you could adjust for. So how do we connect this one to the balance sheet? Well, it's very simple. Down the bottom here, we can see how much cash the business generated. So it generated cash this year of 3.5 million. Last year, it lost 10.9 million, or it used. So we can see that there is an increase in the cash on the company's balance sheet. So that cash at the beginning of the financial year and the cash at the end of the financial year. We go up to our balance sheet And we can see that we've got cash and cash equivalents. So that might include other things that aren't just normal cash. And we can see that we've connected it all together. And we can see all of the assets. So this might be like the property, plant, and equipment, like the vehicles and that sort of stuff. We can see the liabilities, like the debt and the leases that they currently have. And then you can see the long-term debt that they have. And all of a sudden, we've connected all three together. So I've just spent about 10 minutes explaining how accounting works. We start with the income statement, we go right down to profit, we connect that to the cash flow statement through that thing called the reconciliation. We go down the cash flow statement, and then that connects back to the balance sheet. And that's basically how it all works. We're not taught that at finance school, surprisingly, how easy it is. So that's basically how it works. Now, there are courses that you can look at online, and every business is a little bit unique. But basically, when you come to something, you just Google it. And that's what a lot of professionals do, because you don't learn a lot of this stuff. Okay, so I think we didn't probably get as many as I would like on the suggestion front. So if you do have any suggestions of guests that we can have on the show, please do that. So the Australian Shareholders Association did a good article on accounting basis. Might be on their website. Thanks, Tarwin. That's a good thing to direct people to, the Australian Shareholders Association. So just before we go, it is near the end of financial year. A few things. One, if you think about selling all of your shares to claim a tax loss and then buy them back on July 1, as some people do, they think, well, I'll just take the tax loss now and I'll put that in my tax return. Be very careful, because the ATO knows people do that. So don't be so silly as to sell all of your shares and then buy them back. That might not be good tax practice. Speak to your accountant. So I can see a few people are commenting on an upcoming event roadshow that we have at Rask. That'd be fantastic to see you there, Ray. Harry, I don't know what you've said about Xero, but you did have a question earlier on. CP, you've said Michael Kemp. He was one of the people I was thinking of who would be great for the show. So I will chat to Rob off air about Michael Kemp. He's the old Barefoot Investor analyst. He did appear on Big Swinging Stocks, so with Alex. So if you haven't already checked out Big Swinging Stocks, that's the Selfwealth podcast series. He did appear on that. He's brilliant. Ray said Matt from Aussie Firebug. We would love to have Matt on the show. But I think one of the things that might be a bit of a troublesome issue, Ray, is Matt is actually anonymous. So having him on Selfwealth Live might be a bit hard if his face is blurred out. In fact, the first place where he ever revealed his face was at the Rask event last year. Scott Pate would be great. CP, absolutely. Now, Harry said, big ask, but would be great to hear from someone at Xero who is in the position to comment on the newer Xero CEO who's focusing on profitability rather than growing user base. That's great. So I did get the opportunity to speak with, I had the opportunity to speak with the country manager of Xero the other day, Will Buckley. But I didn't actually go through with it. But maybe someone like him would be great. And if we could get Jerry Harvey, that would be nice, wouldn't it, Chef Circle? I'm sure we could ask him about his property portfolio. He's always a character. So, what a great way to finish off our 4-part series with Intelligent Investor. Price is what you pay. Value is what you get. Every index investor, everyone that is investing in an index fund, gets the price. Value investors focus on what they believe is the value of the company. So when we're all invested in an index fund, we just get whatever's in the index. When you're a value investor, you believe that the price isn't always the best representation of what you're getting, but the valuation is. And so you heard Nick talk about that tonight. He talked about how they believe KKR is undervalued. They believe that Floor Decor is undervalued based on what they expect to see in the future. Now, forecasts can be wrong, which is why everyone should always think about the risks before they invest. But I think that's a great thing to remind ourselves, is value is what you get. Okay, so I can still see a few of us here for the last minute or two. I would love to ask you a really quick hypothetical question. Sorry, Rob, I know I've gone over time. Really quick hypothetical question. If you get a $1,000 tax return today or tomorrow or July 1st, hypothetically, let's say you got a $1,000 tax return, what would you invest in? You could say an ETF, you could say a share, you could say anything. You might remember from last year, I'm fishing for ideas, because last year we did a few episodes around where I'd invest $3,000 today, where I'd invest $10,000, etc. And they were super popular. because everyone was getting their tax returns at the time and looking to say, well, hey, maybe I can invest this in the stock market. So, yeah, if you are brave enough to put something in the chat. So CP have said JDO, which, if I'm not mistaken, is Judo Bank. That's an interesting one. Obviously, got a chance to speak to their CEO and co-founder recently. Macquarie says VV. Take the long-suffering wife out to dinner, says Martin. That's money well spent. Maybe, and then there you could do a budget dinner. Not my idea. You could do a budget dinner and then decide where you invest the other $900 together. Wouldn't that be great? Potentially KKR, says Harry. They seem like they're in a good position to allocate capital if valuations get low. Rush Gold, says Tarwin. BHP or VHY, says Robert. La Visa, says Aaron. Macquarie VV. MMS, Linda. What is MMS? Is that Macmillan? That's what ticker symbol is that? Macmillan Shakespeare. It is indeed. If I'm not mistaken, they do novated leasing and those types of things, salary packaging. Yeah, they do. Yeah, I remember them from back in the day. I remember I sounded like a broken record here, but I remember this day. I remember this day in 2013 when the company's share price went from $18 to $8.70. Rob says, I haven't got VHY yet, but I'd likely do the same. That's interesting. So a good mix of companies, a lot more stocks than ETFs in that basket. Interesting. So CP, you've said Kelly Partners, who we just had on the screen. Very interesting business, run by an accountant himself. So he would know the numbers. Well, thank you for a great night tonight. Thank you for sticking around for part 4 of the Selfwealth Live mini-series with Intelligent Investor in the lead up to the end of financial year. We'll be back next week. We've got some great guests coming. And we are taking your suggestions. These DJs do take requests. So thank you for joining Rob and I tonight. Really appreciate it. And bye for now. We'll see you next week. Great one, Caroline. Great one.